Howdy, boys and girls. Welcome to the weekly economic update for February 28th, 2022. I hope everyone had a fantastic weekend out there in the interwebs. Pretty pleasant here in Colorado. It has finally decided to warm up to a reasonable temperature. It's probably got up to about the 50s here where I live, and went into town a little while ago to run some errands, drop some things off, and it was like 65 degrees. I mean, crazy. I mean, after more than a week below zero, and where most of the temperatures were in the single digits for days on end, this is quite pleasant. So going outside, soaking up a little sun. But anyways, if it's your first time watching, please click on the subscribe button. Also share with friends and family. I would greatly appreciate it. And let's go ahead and dive into the how the indexes did today. All right, Dow Jones, not too good. It was down 0.49%, closing at 33,892. SP 500 was down 0.25%, closing at 4373. Let me hit the ignore button on that. NASDAQ was up 0.41%, closing at 13,751. Small caps were slightly up at 0.09%. The VIX went up 9.28% today, closing at 30.15. So again, that's the danger zone. Anything above 30 on the VIX we should have some extreme caution there. But again, we'll see how long before things really start to get bad. I'd imagine probably around the time that the Fed starts increasing interest rates, we'll probably start to see some wobbling in the markets. All right, let's see. Green across Canada. Was this Brazil and Mexico? Then we get into Europe. See, the DAX was down. The UK was down. France was down. The Euro was down. Let's see. One thing was up. The Netherlands had an up market barely. And Portugal. But the rest of Western Europe appears to be in the red. And we get Denmark actually was up 3%. The Russian markets were closed, I guess, because of the sanctions that are going on from the Western European countries and the United States. All right, the Asian markets up, almost all of them except for the Hong Kong Hang Seng was slightly down 0.25%, but everything else, Eastern or Asia was up. Eastern and Western Europe were mostly down, and then here in the U.S. was kind of mixed. The Dow and the S&P were down, but the NASDAQ was up. All right, so not too terrible as far as things go, but certainly could be better. Granted, if the Fed hadn't put us in this position, we probably wouldn't have inflation the way it is. But hey, they don't pay me to make those decisions, so. All right, well, let's dive into the weekly economic update. The week on Wall Street, investors rode a roller coaster of emotions as rising hostilities at the Russian-Ukraine border sent stocks sharply lower before a powerful late week rally erased early losses. The Dow Jones was flat at down 0.06. The S&P 500 was up 0.82. NASDAQ was up 1.08 for the week. And internationals were down 5.72%. So it looks like the international stocks, or at least the developed ones, got beat up pretty good last week, while we fared certainly much better here domestically. Geopolitical events. The buildup of Russia's eventual invasion of Ukraine triggered elevated market volatility, resulting in broad-based selling that sent the S&P 500 into correction territory as the holiday-shortened week trading began. The sell-off culminated on Thursday morning following the overnight incursion of Russian troops into Ukraine territory, though markets staged a powerful late-day recovery that coincided with President Biden's announcing of fresh sanctions against Russia. The afternoon rebound was remarkable as the S&P 500 ended 1.5% higher after being down more than 2.6%, while the NASDAQ composite closed 3.3% higher after dropping nearly 3.5% intraday. Thursday afternoon's momentum continued into Friday as stocks rallied to end the week in positive territory. Invasion implications. Setting aside the more important aspects of human cost and damage to the world, Russia's invasion of Ukraine introduced an acute layer of uncertainty into many layers of the financial markets. The immediate repercussions was the impact on the global economic recovery due to rising energy prices, which reduced consumers' discretionary spending and saddled business with higher costs. The inflationary impact of higher energy and other prices, along with the prospect of decelerating economic growth, also complicates the Fed's strategy to guide interest rates higher. Already, the probability of a 50 basis point rate hike at the Fed March 2022 meeting seems less likely than it was just weeks ago. Finally, Russia's actions have raised new concerns over second-order effects that could further unsettle markets, such as a new round of supply chain disruptions. All right. Economic data coming out this week. On Tuesday, we have the ISM Manufacturing Index. Wednesday, ADP Employment Report. Thursday, we have factory orders, jobless claims, ISM Services Index. And Friday, the employment situation. Got a number of companies reporting earnings this week. Lucid Group on Monday and Zoom. Tuesday, we have Salesforce, Target, and Ross Stores. Wednesday, we have Dollar Tree and Snowflake. Thursday, we have Broadcom, Costco, Best Buy, Marvel Technology, and the Kroger Company. Good old Kroger. All right. So, things are kind of up in the air right now. I wouldn't get your panties in a wad too much about what's going on the other side of the world. It really doesn't involve us, even though our government seems to think that we need to be involved in every single situation out there. All right. Well, let's go ahead and dive into a few articles I got here. First one, S&P ends lower on Russia. Russia continues invasion despite sanctions. This is written by Yassine Ibrahim from investing.com. The S&P 500 closed lower Monday as investors weighed up the impact of hard-hitting sanctions on Russia over its ongoing invasion of Ukraine. The S&P 500 fell 0.3%. We already talked about the indexes. The sanctions included booting certain Russian banks from the global payment SWIFT and freezing Russia's central bank's ability to tap its $640 billion of reserves abroad, which serves as its rainy day fund to protect its economy. Talks between Russia and Ukraine to find resolution to the conflict are expected to resume in the coming days as both sides pledge to keep the negotiations going following the first round of talks. But reports that Russia has stepped up its aggression in Kharkiv as it continues to move closer to the Ukrainian capital of Kiev stifled hopes for a successful outcome on talks. Now, I will always say Kiev because that's how they say it. And the reason my speculation is the reason our government calls it Kyiv is because Putin calls it Kiev and they don't want to be like Putin. So, it's Kiev for you retards out there. All right. Financials and mostly banks led the markets lower as investors weighed up the exposure of U.S. banks to Russia in the wake of tougher sanctions aimed at crippling Russia's economy to deter Moscow to end its invasion of Ukraine. I doubt that's going to happen. Among the biggest decliners, Citigroup fell more than 4% after warning $0.4 billion hit from exposure to Russian assets. JP Morgan, meanwhile, suspended its emerging Europe fund and Russia fund, sending its shares more than 4% lower, as well as the impacts of sanctions on Russia. Investor sentiment on banks was also hurt by falling U.S. Treasury yields, which trade inversely to prices as investors fled to safety. Following Treasury yields or rates hurt the net interest margin of banks, the difference between the interest income generated by banks and the amount of interest paid out to depositors. The Energy was the sole sector in the green as oil prices jumped 4% on fears of supply disruptions amid ongoing geopolitical tensions. BP, however, fell 5% after announcing it would sell its 19.75% stake in Russian oil company Rosneft at a loss of up to $25 billion. That doesn't seem very smart. Rival Shell also said it would exit all of its Russia operations, that it could result in impairments of about $3 billion. Defense stocks, which benefit during times of war, were up sharply as Northrop Grumman and Lockheed rising more than 5%. In other news, electric vehicle stocks were in the ascendancy on bets that soaring energy prices would hasten the adoption of EVs. I highly doubt that. They're not very good, and they will never take over gas-powered engines, unfortunately. So, at least in my lifetime, I think it's a giant waste of money to spend anything on an electric car. And frankly, if you have an electric car, quit using my electricity that's generated with oil and gas to charge up your car. You should be prohibited from using, the regular meat. You should have a windmill or unicorn farts to power your vehicle. Certainly shouldn't be the oil and gas I love using. All right. Next article I got here, home prices post gains across nation. Biggest jumps in the South and Southwest. This comes from the Center Square, written by Brett Rowland. All right. An index that tracks home prices across the U.S. climbed 18.8% last year, the highest in 34 years, with the biggest gains coming in the southern and southwest cities. S&P CoreLogic's Case-Shiller U.S. National Home Price NSA Index reported an 18.8% annual gain in December. The index is designed to track the price path of typical single-family homes located in 20 metropolitan areas. This is the highest calendar year increase in 34 years of data and substantially ahead of 2020's 10.4% gain, said Craig Lazzara, managing director of S&P Dow Jones Indices. All 20 metro areas posted double-digit gains for the year, but the biggest gains were in Phoenix, 32.5%, Tampa, 29.4%, and Miami, 27.3%. Prices were strongest in the South, up 25.7%, and the Southeast, 25.6%, but every region continued to log impressive gains, Lazzara said. The smallest gains were reported in D.C., 10.5%, Minneapolis, 11.4%, and Chicago, 12.2%. We continue to see very strong growth at the city level, Lazzara said. All 20 cities saw price increases in 2021, and prices in all 20 are at all-time highs. Just how much the COVID pandemic and the government's response to it have shifted market demand remains to be seen, Lazzara said. We previously suggested that the strength of the U.S. housing market is being driven in part by change in locational preferences as households react to the COVID-19 pandemic. More data will be required to understand whether this demand surge simply represents an acceleration of purchases that would have occurred over the next several years rather than a more permanent secular change. All right. So I guess if you own property, that's a good thing. Your property values have gone up dramatically, which I know it's something I've seen. I for those who do own properties, I would, as interest rates do go up, I would expect to see a bit of a slowdown in price appreciations. Now, in areas where people are still flocking to and inventory is rather low, may not see much of a change. But in areas where people are trying to escape, if you live in a blue city, you might see your property values start to descend at some point here in the near future. All righty. Next article comes from Barron's. Prepare for a bear market in 2022. And this comes from Bank of America. Or from one of their folks. The recent recovery in stocks may be short-lived, according to Bank of America Securities, which sees a bear market setting in through 2022 and suggests that investors tilt to cash and commodities. BofA laid out a witch's brew of negative trends, signals, and data points in a note published Thursday by Chief Investment Strategist Michael Hartnett and his team. If it walks like a bear, it probably is, they write. All right. So more than 75% of stocks in the NASDAQ Composite Index and 51% of the S&P 500 stocks were already in bear market, down more than 20% from its peak prices, Hartnett noted. Notes, the outlook is worsening with geopolitical risk exacerbating potential for inflation, higher commodity prices, and shocks to growth. Negative real interest rates adjusted for inflation are another ominous sign. Going back 250 years, negative interest rates have been synonymous with crashes, panics, and wars, he notes. Hartnett also calls out signs of cracking in retail and home building, pointing out that Home Depot stock is down 29% from its peak, while builders such as Toll Brothers are off 38%. Declines imply cracks in consumer spending, which rarely happens outside of recessions, he notes. And the Federal Reserve, far from riding to the rescue with market stimulus, is tightening the noose, planning to raise rates and withdraw liquidity to try and quell inflation. We're bearish, Hartnett writes, adding inflation shocks will ripple through to rate hikes and lower growth, resulting in negative returns for corporate bonds and stocks in 2022. Russia's invasion of Ukraine is only making the tough macro outlook look worse. The invasion will exacerbate inflation, which will force central banks to tighten monetary policies faster, according to Hartnett, and the Fed tightening isn't likely to end until we see a recession shock, he says. Put another way, Russia-Ukraine increases the risk of stagflation and policy mistakes, he adds. If we are headed for the dreaded stagflation of the 1970s, which I think we are, investors should lighten up on tech stocks and tilt to cash and commodities, Hartnett advises. Of all the major asset classes, commodities was the only one to produce positive returns during the 1973-74 stagflation shock, triggered by the OPEC oil embargo. Other asset classes that should hold up relatively well include Treasury TIPS, Treasury and inflation-protected securities, small-cap value stocks, and emerging markets, the latter because of their links to commodities. Tactical bets may also pay off. For instance, when the NASDAQ falls to at least 20% below its 200-day moving average, the NASDAQ was down 15% from those averages on Thursday, which may have helped trigger a bounce. Another buy signal would be when at least 80% of global equities indexes fall below their 50-day and 200-day moving averages. Currently, 31% of indexes are below those averages. At some point, market capitulation will set in. The market will be so washed out that it will be time to buy. But we aren't there yet in stocks, Hartnett writes, and the Fed hasn't even begun to tighten. Portfolios should position for stagflation and dollar debasement, he says. While the outlook seems quite depressing, it isn't assured. For all the negatives, one could find counterpoints, including a strong U.S. economy, lower energy intensity in the economy than in the 1970s, and the productivity gains arising from technology and globalization. All right, so we'll go ahead and stop that one there. If you want to finish that up, it will be attached in the notes. So, it's something I've been saying for quite a while. I really didn't see the downturn in 2020 as a true recession or bear market or whatever the hell they want to call it. When the Fed comes to the rescue with wheelbarrows full of cash, it's not really a natural cycle when it just doesn't go through it naturally. You wash out the malinvestment. The companies that survive buy up the ones that don't, or they're liquidated, and just maybe it's a business that doesn't need to be around anymore. So, hey, we'll see where things go. All righty. One last article here. This comes from Brian Westbury at First Trust. His thoughts on Ukraine. All right. They say the truth is the first casualty of war. So here we are, about 1 week into the Russian invasion of Ukraine, and the fog of war is still very thick. Over the past few weeks, it has been conventional wisdom that Russia would take parts of Ukraine, maybe all, and then things would settle down while the world awaited further actions. In the worst case scenario, those moves could include closing current 40-mile wide border between Poland and Lithuania, which could lead to direct NATO military involvement and a wider conflict. So far, things haven't unfolded as many thought they would. Supply chain issues for the Russian military and formidable opposition are slowing Russia's advance. In addition, more sanctions and military help from countries around the world have given many hope that hostilities end early, with Russia falling well short of its goals. If Russia is unable to take control of Ukraine or even forced to retreat, Vladimir Putin could be in more than just political trouble. His inner circle may not like risking access to their personal wealth on what might be believed is an ill-advised military adventure. For Putin, this is a huge incentive to continue his attack and escalate. Nothing is totally clear. What we are more confident about is what the conflict means for public policy. Policies designed to suppress U.S. energy production are going to be tougher for the voting public to digest. The same is true for many European countries, with Germany now discussing building a natural gas reserve. How about green energy? What a waste. Many will keep pushing it, and those projects will continue, but it's going to be tougher to control drilling, extraction, and pipelines for old-fashioned fossil fuels. Meanwhile, Build Back Better, President Biden's plan to raise spending and taxes for the next decade, looks even less likely than before. Yay! War means disruption, and many will argue that we should wait and see how the economy reacts to the conflict. In addition, while the war will likely make global supply chains issues even more problematic and inflationary, the Federal Reserve is likely to pull back on tightening plans because of this potential economic upheaval. A rate hike of 50 basis points in March is unlikely. Great. That's going to screw stuff up. Meanwhile, at least one polling average now shows the GOP ahead in congressional generic ballots by 3.7% over the Democrats. That's certainly not a bad thing. Comparing this to historical readings suggests the government will be politically divided in 2023. In turn, divided government reduces the odds of future tax hikes and spending increases. Problem is that the government is still spending like $4 trillion a year. Probably need to cut that down by about 75% to even start making a dent in the national debt. But hey, in addition, while not related to Ukraine, we think the Supreme Court's recent decision slapping down private sector vaccine mandates by OSHA is a signal that it is willing to limit the power of bureaucrats. This is good news for growth. put it all together, and we think the prospects for more bills that expand government are waning, while the court seems to be more wary of regulatory expansions as well. While war is hell and our prayers are with the Ukrainians, the direct policy is moving towards the better. All right. Well, that's everything I have as far as news and stories to go through. So, just kind of my take on things in the Ukraine and Russia. How come we haven't seen any video of fighting? If Russia's on the doorstep of Kiev, why haven't we seen any cell phone video of battles? Or all we've seen is crappy ring doorbells of missile hitting a building, and I'm curious if that's even in Ukraine. From what I've been hearing is that the week leading up to the Russians coming across the border is that Ukraine was shelling the Donbass region, and they'd also had a dam which had basically cut off all fresh water to those areas that Putin is trying to, in his words, free. So I don't think we're getting the whole story. Definitely not from the corporate media. So my suggestion would be to turn off Fox, CNN, and the like. They're all full of shit. And follow my friend Scott. What's his name? Scott. He's at the Libertarian Institute. No, Libertarian Institute. Scott. Shoot, I'm right here on camera, and I cannot remember it. It's not Scott. Scott Horton. Scott Horton at the Libertarian Institute. Here you can see the website right here. And I read everything he has to say. He's probably the smartest guy on affairs around the world, especially when they're dealing with wars and things like that. So anyways, all right. Well, I'll go ahead and wrap things up here, and I hope everyone has a fantastic evening, and be back tomorrow with the Liberty Call with the daily news of what's going on in the markets and everything there. So hope everyone has a great night, and I'll be back tomorrow.